Hello champions, welcome back. I think this is the last video I will do on this model. This is the 4-hour power of 3 and the lower time frame dealing ranges. So you're going to use it to get this kind of trade that I identified, and yes, so I'll just delete everything and then we'll go step by step to identify that setup. So step number 1, we want to identify a PO3 or CRT high and CRT low. Step number 1, identify CRT high and CRT low, right? And either the high or low has to be swept by the preceding candle. Another way of looking at the CRT high and CRT low is just the power of 3, or ICT is the power of 3, in which case it is the first candle gives you accumulation, the second candle manipulates the first candle, and the third candle distributes. So in our case we have this CRT high and CRT low, right? And you can see the next candle or the preceding candle swept the high of this previous candle or the CRT high. Or alternatively, deleting that, the way to look at it is the power of 3, where the first candle is the accumulation candle, the second candle is the manipulation candle, sweeping the high of this first candle in our case. And now we anticipate the next candle to distribute, and that is where we intend to take those trades. So after identifying that, the sweeping slash manipulation candle gives us a dealing range that we will work with. Mark the premium, and or slash discount zones of this dealing range. So that is the first step. Before you go to that, you want to make sure the manipulation slash sweeping candle is reacting of a PD array, in our case a fair value gap. So let us do that. That is the first step. Identify the CRT high and the CRT low, or the power of 3. We have this candle, bullish candle, and then we have this bearish candle, indecision candle, because the body is quite smaller than the wicks. And then you will notice these two are inside a fair value gap. So what are we expecting? This for our fair value gap. We are expecting the next candle to drop lower to the to go lower to give us sell setups. So we are assuming this candle has not yet opened, but that is where we are supposed to get those sell setups. Now we have said the sweeping or manipulation candle gives us a dealing range. So this candle, this sweeping or manipulation candle, or what I mean is the sweeping candle is this candle swept the high of this candle. So this candle gives us a dealing range. So let us mark that dealing range straight away. The high and the low of that candle, like that. You want to be as accurate as possible, right? And then we mark the premium of this dealing range. Why are we marking the premium? Because in this power of 3 or CRT high and CRT low, we are anticipating for the next candle to open and come into this premium and then drop. So that is the completion of the first step. So this is the 4-hour premium. I'll give it a different color as well, like that. Now the next step, drop to the lower time frame. In this example, I have framed the 4H time frame to the 5-minute time frame, right? And identify CRT 2022 model. If you don't know what that is, you can go watch it on his YouTube channel, or just go through the YouTube and find these things. But I'll just show you what ideally that is in this case. So we are going to identify the 2022 ICT model in the lower time frame, in our case the 5-minute time frame. So you go to the 5-minute time frame, like that. Now you see where this arrow is where the last 4-hour candle closed, the sweeping candle closed, and the new 4-hour candle opened. And now we are identifying 3 things. The first thing is we want to see a liquidity sweep to the upside, which is this one, or even a more recent one, this. That was liquidity sweep to the upside, right? And then the next thing we want to see, actually even this also is a liquidity sweep, and I want to believe that is the sweep we identified in the higher time frame, the 4-hour time frame. The sweeping candle, this is the high of that previous candle, or the CRT high and CRT low. So this is the CRT high, swept and price dropped. And then the next thing you identify is prior to this upside move that swept this liquidity, where was the last swing low? And this was the last swing low, right? This swing low was price closed below it, giving us a market structure shift. So what I'm doing is the ICT 2022 model. So that is liquidity sweep right there, and then we also have this as another form of liquidity sweep, then a market structure shift, right? ICT 2022 model also, the next step is in the ICT 2022 model is identify the fair value gaps and inverted fair value gaps or breaker blocks for this, for entries, right? In our case, I think we can now get rid of this because it's just given us an area of value. In our case, we have a fair value gap, tiny one, right there. And then an inverted fair value gap right here. So this is IFVG and this is FVG. So as per the ICT model, these are your entry areas. Remember, the new 4-hour candle has opened, the one we anticipate to take trades on. You can see price comes back up, violates this fair value gap and respects the inverted fair value gap. Therefore, this fair value gap is not meaningful anymore, right? And then you can see price drops to go lower, right? So there's a reaction of this inverted fair value gap and price drops. ICT 2022 model tells you to take your trade once a candle closes outside this area, stops right above there, and take profit, maybe that 1.8 or this 3.56, or you can take a strict risk reward ratio of 3, right? So that is the ICT 2022 model, but we will be adding another layer of dealing ranges to this situation right here. So ICT 2022, let me just write that down. ICT 2022 model, identify liquidity sweep or liquidity rate followed by a market structure shift. Then look for fair value gaps, inverted fair value gaps, or breaker blocks where price is likely to react off, right? So that is the 2022 model ICT. But this is not going to be our entry. Instead, we do take a step further and identify an engulfing candle of their fair value gap. Now this, in our case, it is the FVG, right? The inverted fair value gap. This step number 3 is mimicking this step number 1 right here, where we get a dealing range, right? A dealing range from the engulfing candle outside the fair value gap. Price is fractal. You can see the 5-minute candle bullish opens, closes inside the fair value gap. The next candle opens, right, and drops lower. So this candle sweeps the high of this candle and drops, right? And then now we have that series of down close candles. What we are doing with this, we are getting finer entries and tighter stop losses, right? So this dealing these candles or engulfing candle, this candle or a series of candles that we combine into one engulfing candle will give us a dealing range. We mark the premium and discount of this dealing range. Okay, in our case we will be marking the discount, the premium of a dealing range, because we are anticipating for sales. Remember, if you are using DRT or dealing range theories, you only sell in premium and buy in discount. So coming back to this place, we have a liquidity sweep and a market structure shift right there. So this candle closing below it, these two candles will give us a dealing range that we are going to use, and also these two candles combined will give us what? It will give us one large engulfing candle out of this dealing range. And that is what I meant by there is a slight difference in how we identify an engulfing out of the fair value gap, outside the fair value gap. So these two candles will give us that dealing range. In a situation where you have one large candle that gives us a market structure shift of the previous candle, that one candle will give us the dealing range. Therefore, you mark the high to the low of this candle, you want to be as accurate as possible, right, to the low of this candle, like that. And then this inverted fair value gap has done its purpose. Now you want to get this dealing range. So this now is the 5-minute premium of this dealing range. Can delete everything else to make it a bit cleaner. Remember, this is happening in the new 4-hour candle, and this 4-hour candle has opened, is now giving us the high of this candle, the 4-hour candle, and then it will drop. So deleting this Fibonacci, we want to see what happened. There's a bit of inaccuracy in the way I drew the dealing range, so let us just get it well. Right, like that. And then this is our premium, right? Now I want you to see something for yourself. The 5-minute candle closed. You marked your dealing range very fast because you have to be quick, and then the next 5-minute candle opened and tapped into the premium of this dealing range and kept dropping. So as this 5-minute candle is opening and giving us this wick, we are placing a sell limit at this point, right, on the exact 50% line, and stops right above that premium. Okay, so, or you can still wait until price comes into this premium and then execute your market order So we have this stop loss right above this dealing range, a few pips above the dealing range, and then now you start doing your take profits based on the market structure. For example, take profit number 1 at this low here, giving us a 3.57. The next take profit at this low here, giving us a 6.24. And then take profit next is at this area, 11.18, or this area, 12.98. Why would you want to do that? This is the final take profit because these are relative equal lows. So that is the best or the optimum take profit. You can still target this, giving you a very high, right? Very high win rate. You can see it went all the way to 17. But our purpose is to get at least 4 or 5 R for conservative trading, or at 10 R for trying to flip accounts. So another thing, we had our stops right above the premium price. You will notice it never came back into this stop. In fact, we had a sniper entry, zero drawdown entry at this point. You can see if you had one, it's because of the commissions your broker will charge you for every trade you place, but this was a zero drawdown entry. And maybe you will want to place now, adjust the stop to also cover this inverted fair value gap. Yes, price react off this fair value gap off, and then come and go higher and then drop. So stop loss at that high, and that would have given you maybe a 10, 9.37 or a 10, depending on how you execute your orders, right there. So that was a 9.6. And that, guys, is how you take this right trade. So this is, I did not finish the steps. Go to step number 4. Wait for price to come to the lower time frame premium or discount. In our case, it was the premium, and then execute your sales, your orders, either at market price or pending orders. I have shown you how to set your stop loss and take profit. Stop loss above / below the dealing range, and take profit based on the market structure, or you can target a fixed take profit based on RR. The best one I recommend is 4 RR, or you can also do 3 risk to reward ratio. And that, guys, is how you take those entries. This model is the 4-hour PO3 or power of 3. Others choose to look at it as CRT, and the lower time frame dealing range or dealing range theory. You can see I've named it as 4-hour PO3 plus DRT, and this is meant to give you a high risk to reward ratio and tighter stop losses and sniper entries. So that is it, guys. Go have a look at it, back test it, forward test it, and see if it will work for you. This is the final video I'm doing on this model. Now it's time for us to go and learn and execute what we have learned. I'm also still forward testing the model, so we are still in the learning phases and we see how this goes. All the best. Have a fantastic day or night.